Good day, everyone. I'm Fuji Jun, and today I would like to introduce our company, Your Loyal Ice Cream Enterprise. Our team members are Chu Entong, Fu Zijun, Lao Jiaxing, Lim Jiaqi, Loi Qiangli, and Tan Huishi. Basically, our company manufactures box ice cream, which will serve in family-size packaging of 1.5 liter per box and individual-size packaging of 0.5 liter per box. We will distribute our products to supermarket, convenience store, cafe operator, and so on. Our aim is to offer high-quality product at competitive pricing and with a wide array of flavors that can cater to different groups of consumers. Not to be worried that our raw materials are sourced from certified and reliable suppliers, and we equip proper cold storage facilities to ensure our product freshness and quality. Definitely, box ice cream is highly viable in Malaysia due to the hot and humid climate, which increase consumers' desire for cold and refreshing dessert. This reduces the risk of demand fluctuation and provide a stable and positive cash flow for our company. Also, our ice cream is affordable for middle and lower income groups, which matches Malaysian economic condition. Compared to single-serve ice cream, box ice cream offer better value with lower prices and larger quantities. Lastly, box ice cream considered as a budget-friendly product that target to price-sensitive consumers. This affordability would undeniably reach large market segment and maintain our sales volume even facing inflation in year to year.
Hi everyone, my name is Chu Entong. I will be presenting how each of the objective of managerial accounting activity would be important in the context of the business. In an ice cream manufacturing business, managerial accounting is vital for strategic planning and informed decision making. During the planning stage, it allows management to estimate costs for raw materials, labors, and overhead, which are essential for setting competitive price and managing seasonal production volumes. Performance evaluation is another core function. By analyzing probability across product lines such as premium versus regular ice cream, and distribution channels like supermarkets or cafes, management can identify high-performing areas. By comparing actual results against budgets helps pinpoint where production or sales targets are falling short. Furthermore, these financial insights help assess the competitive landscape. By comparing cost structure with rivals, a business can decide whether to compete through pricing, superior qualities, or product differentiation. This data also helps identify target customers by highlighting which segments, such as family or retailers, generate the highest margin. Risk management is equally critical. Managerial accounting quantifies risks like fluctuating dairy price, equipment failures, and seasonal demand shift, allowing for better cash flow planning. Finally, it supports long-term growth by providing rigorous cost-benefit analysis for capital investments, such as purchasing new machinery or expanding facilities. This ensures that every strategic move is backed by financial data to secure the company's future.
Thank you, Anton. Hi, everyone. My name is Lim Jiaqi, and I will be presenting the initial capital requirement for Your Ice Cream. Based on our cash budget, we require an initial capital of RM50,000 to begin our operation. This is needed to support our early production activities, such as purchasing raw materials, direct labor, overhead costs, and equipment. Since 20% of our sales are collected in the following month, this 50,000 help us to maintain cash balance and also ensure smooth operation, with only minimal short-term borrowing in the first month.
For the intended budgetary process, Your Ice Cream used a top-down budgeting approach, where top management set the overall targets and budget limits. These are then passed down to departments like sales, production, and finance. Since decisions are made centrally, all departments follow the same direction and work toward the company's main goals. Next, for the impact of the top-down budgeting process, first, it gives Your Ice Cream strong centralized control. Top management approve all key budgets such as sales, production, materials, labor, and cash. These ensure all departments are aligned with company targets like producing 10,861 units and achieving 264,800 ringgit Malaysia in sales. Second, it speeds up budget preparation because decisions are made at one management level, allowing quick adjustment when sales or inventory change. Finally, it creates clear roles and responsibilities, so each department knows what to do, reducing error and misunderstanding. The impact of big data analytics. Your Ice Cream uses big data to improve its budgeting process. It helps track performance by comparing actual results with the budget, so problems like low sales or rising costs can be detected early. Big data also improve forecasting by analyzing past sales and customer data, allowing management to make more realistic plans for production, material, and labor. Finally, it supports better decision-making by identifying key cost drivers and help management choose the most efficient budgeting option.
Now I'll be walking through our master budget for Your Ice Cream Enterprise for the first quarter of 2026. Starting with our sales budget, we are projecting a steady month-over-month growth of 10%. We expect to move 8,000 units in January, scaling up to 9,680 units by March. Maintaining a consistent selling price of 10 ringgit per unit, this brings our total projected revenues for the quarter to 264,800 ringgit. To meet this demand, let's look at our production budget. Our policy is to maintain a desired ending inventory. For example, we have set aside 1,760 units in January to prepare for our February sales. After accounting for our beginning inventory, we need to produce a total of 28,610 units across the quarter to stay on track. Overall, the number shows a healthy growth trajectory. Our main focus will be ensuring our production facility has the capacity to handle the 9,874 unit peaks we expect in March.
Next, we proceed to direct material budget. We can see that each unit of ice cream requires 1.5 liters of materials. We can calculate the total materials required based on monthly production and the desired ending inventory. After deduct beginning inventory, the total materials to be purchased for the first quarter are 44,544 ringgit. For direct labor budget, each unit requires 0.2 direct labor hours and the labor cost is 6 ringgit per hour. Based on total production, the labor hours required for the first quarter are 5,722 hours and result to a 34,332 ringgit of total direct labor cost. Our manufacturing overhead budget includes indirect material, set-up wages, cold storage, factory rent, insurance, and maintenance. This gives us a total of 80,200 ringgit for the first quarter.
Hi everyone, my name is Charlie and now I will present the Selling, General and Administrative Expense Budget, which outlines our estimate operating costs. Variable expense increased from 4,000 ringgit in January to 4,840 ringgit in March due to higher sales volume, while fixed expense remained constant at 2,000 ringgit per month. Total cash disbursement for selling and administrative expense amount to 10,240 ringgit for the quarter. This budget helps us to control costs and plan cash outflows efficiently. Next, the cash receipt budget shows how cash is collected from sales. We assume 80% of sales are collected in the month of sale and 20% in the following month. As sales increase monthly, total cash collections rise to 245,440 ringgit for the quarter. This budget ensures sufficient cash inflow to support operations. In addition, the cash disbursement budget estimates payment for materials. Payments are split to 50% in the month of purchase and 50% in the following month, resulting in total cash payments of 33,408 ringgit. This helps manage supplier payments and maintain healthy cash flow.
Continue with our cash budget. We begin with a starting cash balance of RM 50,000, which is our initial capital. We then add with cash collection and deduct with cash disbursement, which taken directly from our previous budget. In January, we borrow RM 8,502 ringgit. Then we repay it in February with 1% monthly interest. By the end of quarter, our ending cash balance is RM 69,987 ringgit, showing our business maintains stable cash flow. Next, let's move to cost of goods manufactured. We added up direct material use, direct labor, and manufacturing overhead, become total manufactured cost, which is RM 167,684 ringgit. Then we adjust with work in process inventory, becomes cost of goods manufactured, RM 158,784 ringgit. Moving on to cost of goods sold, we take the cost of goods manufactured, adjust with finished good inventory, result in cost of goods sold of RM 143,884 ringgit. Next is the budgeted income statement. We take our revenue from the sales budget, deduct with cost of goods sold, and get our gross margin. Then we deduct with operating expenses to get our net income, which is RM 131,241 ringgit. Then we move to the budgeted statement of cash flow. We start with cash receipts from customer, deduct with cash payment to get our net cash flow from operating activities. Then we deduct it with equipment purchase and also considering financing activities. And we will get a net increase in cash of RM 19,987 ringgit for the quarter. Then we will get an ending cash balance of RM 69,987 ringgit. Lastly, we summarize everything in the budgeted balance sheet. Our total current asset, including AR, cash, and inventories, is Rm 115,591 ringgit. Adding up with our non-current asset becomes total asset of Rm 160,591 ringgit. These assets are funded by accounts payable, capital, and retained earnings, so the balance sheet balanced correctly.
Next, I will explain the key assumptions used in preparing the budget for YOLO ice cream enterprise. First, there are uncertainties in sales and expense forecast because the business is new and lacks of historical data. Sales may function due to his seasonal weather, with rainy reducing demand and hot periods increasing it. Consumer preference and competitors' pricing strategies may also impact actual sales. On the cost side, raw material price changes, unexpected equipment maintenance, and potential labor adjustment could cause expense to differ from budget. Continuous monitoring and flexible budgeting are therefore important. Our competitive position relies on affordable pricing at 10 ringgit per unit, consistent product quality, and sufficient production capacity. Investment in equipment allow us to meet growing demand, but strong competition and substitute product require us to keep evaluating market trends and customer preference. Regarding business risk, we face demand volatility, cost inflation, equipment breakdowns, and short-term cash flow pressures, especially in the early stage. These are managed through careful planning, conservative cash budgeting, and short-term financing. Finally, our target customers, students, young adults, and families are price sensitive but value quality, variety, and convenience, which support stable sales and long-term growth.
Hi everyone, my name is Hui Shi, and today I'm going to discuss how we implemented activity-based costing system into our business. Firstly, we have identified 6 cost pools which fall into 3 broad categories. For example, machine maintenance are fall under unit level activity, while setup wages, purchase, and storage material handling are fall under batch level activity, since this activity must be performed for each batch of product. In addition, factory insurance and rent are example of facility level activity. Next, we had assigned different cost driver for different activity. For example, cost driver of setup wages are number of production runs, because setup activity happen every time a new production run begin. Now, we will proceed with ABC calculation. Let us use storage and material handling as an example. Firstly, we calculated the activity pool rate by dividing activity cost, which is 9,200 ringgit, with cost driver quantity 4,600, and we'll get 2 ringgit per day. Next, multiply it with cost driver quantity for each product line to get activity cost for each product line. Finally, divide the total activity cost by the production volume, which is 28,610, and you will get 32 cents for activity cost per unit. Now, we are going to compute overhead costs and product costs using both methods. Under the activity-based costing system, the overhead cost per unit is obtained by summing up the overhead costs from the different activity categories, which result in 2 ringgit 80 cents per unit. In contrast, under the traditional volume-based costing system, the overhead cost per unit is calculated by dividing the total overhead budget of 80,200 ringgit by the total production volume of 28,610 units, which also give 2 ringgit and 80 cents per unit. After that, the direct material cost per unit of 1 ringgit 56 cents and direct labor hour cost per unit of 1 ringgit 20 cents are added to the overhead cost under both costing system, resulting in the same total unit product cost of 5 ringgit 56 cents. Based on the result, the unit product cost calculated under both traditional volume-based costing system and activity-based costing system are the same, which is 5.56 ringgit per unit. Therefore, there is no cost distortion with single product because all overhead costs are assigned to that product.
That's the end of our presentation. Thank you for listening.